Hi everyone, this is Priyanka Kishore from Asia Decoded. Welcome and thank you for tuning into our podcast on the conflicting economic signals coming out of India. I'm delighted to be joined today by Shilan Shah. Shilan is Deputy Chief Emerging Markets Economist at Capital Economics, where he also leads the India Macro and Markets team. He was based in Singapore for several years before returning to London in 2022. Shilan is a leading commentator on India, frequently quoted in Bloomberg, the Financial Times, and Indian media outlets. I am really pleased to have this opportunity to unpack India's economic outlook with him today. Hi, Shilan. So let's start with the question on the top of everybody's mind, which is why are investors suddenly so worried about the fastest growing emerging market, one of the fastest growing emerging markets in the world at this point of time? We've seen $16 billion worth of net outflows in FY 2026 in terms of portfolio outflows. FDI into India has stalled. What do you think explains this disconnect between India's stellar growth statistics and investor sentiment towards India?
Yeah, it's been really interesting. And I mean, I think there's quite a lot to unpack there. Probably the place to start is to say that growth and investor returns are not really the same thing. For me, India's growth story remains a very compelling one over the medium term. I think that that's more of a gauge for FDI flows than the short-term story is. Most people are well versed in the positives of the Indian economy over the long term, right? So good demographics, pretty stable politics, a big scope for productivity gains. But I think that investors are increasingly sort of questioning the valuation that's attached to that story. So, for several years, India's benefited from that sort of scarcity premium as the main sort of alternative to China, for example, and the relocation of supply chains. So that pushed equity valuations to really, really high levels. And perhaps those valuations have just become a bit more difficult to justify purely on the fundamentals. At the same time, economic growth within India has become a bit more uneven, you could argue. So public investment has been very, very strong. But at the same time, private investment and consumption, the stories there have been a bit more fragile. So, investors are asking whether the economy can consistently sort of grow at the rates that was suggested or implied by those valuations. And I think the other point to make at this moment is that India, it's not really at the forefront of the AI revolution. So capital does seem to be flowing out of local equities and into markets where the AI play is stronger. So places like Korea and Taiwan, for example, which have much stronger AI stories. Going back to FDI, it is difficult to sort of gauge where expectations were, but what we can say is that the whole sort of China plus one story was never going to lead to a wholesale sort of relocation of supply chains to India. I do think that there has been some progress, but it's probably been sort of slower and more selective than people had been anticipating, say, 4 or 5 years ago.
You made several excellent points in that response, and let's just drill deeper into a few of them one by one. Let's start with the valuations. You were talking more about equities, but the rupee has also depreciated nearly 10% or a bit more since 2024. Is that a valuation story as well? Is that just a correction to the levels matching the external account because of heavy RBI intervention, which had kept it artificially strong? Or I know you talked about both the pros and the cons, but you don't think that there are any deeper confidence challenges that India should be worried about at this point of time, other than the ones that you've already spoken. But yeah, more about from a valuation perspective, where does the rupee look now?
Yeah. So my view on this is that the depreciation that we've seen in the past few months is primarily a correction rather than a sort of deeper confidence crisis. If we go back a few years, the RBI was leaning very heavily against depreciation pressure. So that meant that the rupee adjusted less than many other emerging market currencies did. Particularly, that was the case under the previous RBI governor, Shaktikanta Das. He kept a very tight leash on the INR during his tenure. Really, it barely moved at all. So as those sort of pressures accumulated, then I think some catch-up depreciation since the rupee's been let go a bit. I think some of that catch-up depreciation was inevitable. And then more recently, the rupee's weakness is also just reflecting a less supportive external environment, particularly over the past sort of few months. India, as everyone knows, is a major net oil importer. So it has suffered in terms of trade shock with the oil price spike from the Middle East conflict. And it's also going to get hit as the expectations of higher inflation and higher interest rates in the US feed through to a stronger dollar as well. So, yeah, all of that suggests to me that what we've seen is really more of a correction and more a reflection of the realities externally that India faces, as opposed to a very deep sort of confidence issue within the economy. I think the other point that sort of argues against the idea that there's a real sort of crisis of confidence with India is that it's not really facing the kind of classic external vulnerabilities that you'd expect ahead of a confidence crisis. So, the current account deficit probably will widen over the next few quarters as a result of the energy shock, but actually came into the crisis with a very small deficit. You mentioned this point around FX reserves. I think that they remain sort of healthy enough, really. I know that there's a bit of concern around the size of the RBI's forward book, but I think even if we account for that, FX reserves still look in relatively decent shape. External vulnerabilities generally look pretty manageable, especially when we compare it to, say, 2013 and the taper tantrum, for example. So, yeah, the short point being is that I think a lot of the weakness that we've seen really reflects a correction rather than deeper sort of structural problems or confidence in India's growth story.
So I know, Shilan, you were in India recently with GTR, meeting with people, talking about on-the-ground sentiment, taking gauge of it. Would you say that the on-ground sentiment then is perhaps more pessimistic compared to the view that you're giving here? At least reading some of the headlines, it does appear that there's much more concern for the rupee and the outflows within India than the picture that you're painting right now.
I think that's probably true. Yes. It also captured the zeitgeist of that week or that month, right? The rupee was at I was there the week that it hit the record low, close to sort of 97 to the dollar. So invariably, that ends up forming most of the discussions that you end up having. And there was a sense there that, well, how far can this go, right? Does it go to 100? Does it go beyond that? And of course, since then, we've seen a bit of a pullback in the rupee, partly because of the measures that were introduced by the RBI and the government earlier in June, but then also because of the peace deal between the US and Iran, which has led to this pullback in oil prices. So I think that, yeah, there certainly did seem to be a bit more concern about how far the rupee would go, speaking to people on the ground there. But from a sort of a slightly broader or outside perspective, a lot of the forces that have been driving the rupee, I think, are perhaps less to do with what's going on within India itself, and more to do with this external environment where you do have a stronger dollar because of these rate expectations, and then up until recently, very high oil prices as well. I know it's a bit of a truism, but if oil reaches $100 per barrel, then invariably that leads to stresses on India's external position, and I think that the movements in the rupee were just have largely been a reflection of that.
On that bit, there is some reason for optimism. At least we have, after several starts and stops, the reopening of Hormuz, and we have to see how it goes. But one thing India did avoid was, outside of LPG, widespread shortages. So far, it diversified suppliers. It managed to get imports. It was, allowed Russian imports, and now Iran is back to exporting crude to the world as well. So I imagine that India's external position could be better. These risks have gone lower. How do you view the Hormuz related risks in general and for India over the next several months?
Yeah, so there's a few things going on. I mean, the lagged impact of the energy shock and the surge in oil prices is going to take some time to feed through into the official data. So I think what we're likely to see is a widening in the current account deficit over the next few quarters. But that's capturing, oil purchases that were made during that period of very high prices when it wasn't clear that we were going to get a resolution. So that locked in refiners paying quite high prices. The other impact that I think will lead to a widening of the deficit in terms of the upcoming data is the hit to remittances, right? So I think 30 or 40% of remittance inflows into India come from the Gulf. The Gulf, activity on the ground very much impacted by what was happening in terms of the war between the US and Iran. That could lead to a slowdown in remittances as well. So we're likely to see that showing up in some of the upcoming data as well. So I think we're going to be in this situation where the data are showing widening external deficits, but then actually the situation on the ground has clearly improved because of the reopening of the strait. Provided that that remains the case, it is a fragile truce, but provided that that remains the case, then some of these external pressures that India has been facing should start to ease back. So I think that when we look at the sort of external position, there is going to be some continued depreciation pressure on the rupee. Whilst we have this lagged impact working through the economy, but then things should start to ease up in the latter part of the year. And then, of course, the other point around sort of continued rupee weakness is really less to do with some of these points around the Middle East conflict and more to do with some of these outflows, particularly from equities. As I mentioned, I think the AI story is or lack thereof in India's case is probably another pretty big driver of those outflows and putting sort of continued depreciation pressure on the rupee over the coming months.
So let's talk a bit about these structural stories. You've alluded to some of them, spoken about China plus one. But before I talk about AI or China plus one of the stories until recently was a big question mark on India's GDP statistics itself. And several consultants were, speaking to the government, advising them on how to revamp the series. And eventually, we have a revamped series out. It still shows India grew nearly 8% in FY26. Is this now a more credible statistic? Is there a concern around that figure? Still, how do you see it?
Yeah, I think the first thing to say is that really it's no mean feat to overhaul national accounts data in a country like India, right? Obviously, enormous, many complexities. So, for that, I think the Statistics Office should be commended. You mentioned some of the outreach that the Statistics Office undertook ahead of the revisions. Again, I think that was a very positive step in terms of speaking to external organizations, to try to introduce best practices. And the changes are positive. GDP has been rebased from 2011, 2012 prices to 22, 23 prices. That's a really important upgrade. It better reflects shifts in expenditure, as well as the emergence and growth of new sectors. And in addition, several new data sources are being used in the updated estimates. The new estimates also doing a bit more to capture the informal sector too. So all of these are really encouraging and positive changes. But at the same time, as someone who watches India's economy, I think you are left wanting a bit more, really, in a quite literal sense. The new series only go back to 2022, so I think it's difficult at this point for forecasters to pick up any structural changes in the economy. The Statistics Office has said that it will release, the full back series in due course, but until then, we are left in the dark somewhat when it comes to forecasting. And another point is that in the new series, does look remarkably stable when we look at the real GDP numbers, year-on-year growth rates at least. And I think it's so stable, probably to the point that it's actually quite hard to pick up cyclical changes in the economy as well. So, yeah, I mean, overall, viewing the revisions, is a really encouraging step forward, but I don't think it's the end of the debate just yet. And as for the sort of what the numbers are showing, so the 8% growth rate, for example, that you mentioned, perhaps I would focus less on the exact number, but more on the sort of broader message. I do think that India's economy is still clearly growing at a pretty healthy pace by global standards. I don't really think that that's in doubt, but perhaps under the hood, some of the growth drivers are becoming a bit more unbalanced, which in some ways is the bigger problem than the overall number itself, because you've got public infrastructure doing a lot of the heavy lifting, so to speak. Private sector largely remaining on the sidelines, which I think is something that policymakers should be pretty concerned about.
So let's talk a bit more about the private investment, where it can come in, and the evenness. So one thing that the government has leaned on to bring in foreign investment and maybe lure in private investors as well are data centers, right? And you've alluded to AI related developments in India not being quite enough compared to other countries. In some sense, India is an AI laggard on all aspects at this point of time, I would say. How important is this from a long-term perspective for India? Can India just lean on data centers given its issues around uh, water, energy, etc.? It also has low digital literacy comparatively at this point of time. Is India's outlook in the long run, medium to long run, really challenged by its AI positioning? Or can it catch up?
Yeah, again, I think there are many ways to sort of look at this, really. In terms of the sort of hardware around AI, the data center build out, that is an area that the government does seem to be promoting. Lots of subsidies being announced in the budget from earlier this year for the data center build out. Some pretty big plans amongst the US sort of hyperscalers to build out data centers in India. We've seen evidence of it on the sort of outskirts of the major cities as well. Places outside of Mumbai, Bangalore becoming data center hubs essentially. But I think you're right. I think that there are some potential constraints on how far that can go, at least as things stand. And two of those are the availability of electricity in order to power these data centers, but also water scarcity as well. So I suppose that the hope is that by encouraging the data center build out, the government then does more to tackle water security and energy security as well. So it kind of leads to this sort of cascading effect of reforms. But that's the hope. And if we don't get there, then yeah, of course, India's going to be constrained in terms of how much it can really lean on the data center build out. On sort of AI adoption, implementation, leadership, etc. Yeah, again, there are a few ways of cutting this, really, and India is quite unique for an emerging market because of the size of its and the success of its services sector and its services exports, and that's exactly the type of sector that AI is providing both a pretty big threat to, but also big opportunities to as well. And so, when we talk about GCC capabilities, outsourcing. Now, I must admit, we were probably 2 or 3 years ago pretty pessimistic on the impact that AI would have on India's economy through those channels. But actually, the data that we look at since then, so things like services exports, have held up remarkably well. So it feels to me that the story is more nuanced than just assuming that generative AI in general is going to kind of completely undermine India's services sector story. And actually, I think that it's more about how AI is adopted within the outsourcing, within the GCC sector. And actually, it becomes less around undermining the entire industry and more about, well, what does it mean for labor in particular? So the growth still seems to be coming through in the numbers, and what we have less of a grasp of really is what it means for the labor market. We do hear some of the big IT and software firms in India announcing some pretty significant reductions to headcounts. So that is a bit of a concern. The tendency is to always blame reductions in headcounts on AI. We can't really know for sure, but there does seem to be some displacement of labor. So I think that the issue is less around what AI means specifically for the economy from a kind of productivity perspective, and more around what it means for the labor market, and can some of those workers in the IT sector, for example, be reskilled or upskilled to then start using AI more effectively themselves. So I think that's really the big question for policymakers. One other point that I think is worth making, because whenever discussions around AI comes up in the Indian context, there is a tendency to frame it around what it means for the services sector, right? And I've just done the exact same thing because of India is unique in that regard. But stepping back, there are some broader sort of applications of AI in things like healthcare, things like education, where India has historically fallen short, where this technology could lead to really big and really positive productivity gains. Even quite simple applications of AI, things like lesson planning and translation, or in some fairly basic uses in healthcare, which are already being used both in India and elsewhere globally. Those could lead to some pretty important productivity gains, boost to human capital as well. And India, as a country that is still pretty poor in per capita terms, is somewhere that could really benefit from that. So, yeah, I think it's important to sort of broaden out discussions around AI and India beyond just the services sector, and to think more generally about how it could be sort of diffused across the economy. And I think when we do that, then actually India does stand to benefit from the technology more generally.
I completely agree. I mean, I also would add that the obsession with catching up on foundation models, I think the focus on that would perhaps be better if they refocus it on diffusion and the uptake that you were talking about across different sectors, rather than trying to become a lead developer of a LLM. India could benefit a lot from AI applications. It could do wonders for that uneven growth that you were talking about, right? I couldn't agree more. But at the same time, India is actually looking for another channel of growth, right? It wants to sort of move towards the export-led growth model, the manufacturing export-led growth model. Ever since China Plus One came into play, the timing is, I would say, difficult, if not, some would say even unfortunate. But they did make a good start. They made a good start with Apple coming in. But since then, things have not really looked that promising in terms of whole ecosystems developing and a lot of other companies following Apple into India and mass. And do you think, to at least some extent, the slower forms and the generally weak manufacturing ecosystem are not denting India's chances as China Plus One? I heard you when you said that India was never going to be the leader in terms of supply chains coming in, but is it maybe in a weaker position even than maybe it was in 2016? Is that what has happened?
Well, I think I think it's important just to acknowledge at least that India has made some progress over the past decade. Um, you know, reforms around labor, land, um, state level sort of implementation of other reforms as well. I think is going in the right direction, but perhaps the problem has been that um, a lot of these reforms remain incomplete or are only at the sort of very beginning of how far these reforms need to go. One good example of this, I think, is the sweeping labour market reforms that took place at the end of last year. Um, they were first tabled in 2020. They took 5 years to be implemented, so already there's a pretty significant delay there. And then even then, implementation is not the same thing as firms actually executing those reforms as well. So then it comes down to the firm's willingness and ability to actually adhere to those new labour market reforms. So I think I think that all kind of feeds into this idea around India and China plus one, or perhaps not being able to kind of fully capture that advantage that, the pace of reforms are heading in the right direction to my mind, but it's all just taking, perhaps longer than people had been expecting, say sort of 5 or 10 years ago. And of course, then the other problem to this is that China plus one itself, there are some questions around it, right? China, especially at the kind of lower end of the manufacturing scale. So we're not talking kind of high-end electronics because to your point, India has managed to capture some global market share in things like electronics with the movement of Apple into the country. But I'm talking more about the sort of lower end labor-intensive manufacturing. China remains extremely competitive, and it's really rewritten the rule book, right? Because it's turned these low end manufacturing sectors into something more sort of capital intensive. So the labor advantage that India has is less of an advantage now than would have been the case, say, 10 years ago. The Chinese exporters are, I think I read a statistic somewhere that around 30% of them are now loss making, but of course that can be sustained in China, right, with implicit backing from the state. So it's becoming very, very difficult for countries, not only India, but also beyond India, places like it's in Southeast Asia, other parts of South Asia, to compete with China. China's been able to grow its global market share in some of these low-end manufacturing sectors over the past 5 years. So that's just the reality that India has to live with. That's not to say that there's nothing that can be done, because as we mentioned, reform momentum probably could be faster. But I think that the reality is that hopes of India sort of kind of replacing China, for example, just feels too far fetched. China was able to sort of emerge as this kind of manufacturing leader because there wasn't a China before it. India doesn't have that same luxury, right? Because China's still there, and it's it's continuing to kind of capture market share. So India has to fight for its place within that, really. I've gone sort of a bit roundabout here, but just coming back to your point on high-end manufacturing, I do think it's important to highlight some of the progress that has been made in those areas, though for India. This case study around Apple is of course a very important one, and the hope is that over time that leads to an ecosystem of electronic suppliers to then develop more local sort of supply chain. But there are other areas where India has captured some market share as well. Defense and arms over the past few years is a sector that has been doing very well in terms of manufacturing. Pharmaceuticals has always been a fairly strong point for India, and it's continuing to capture global market share there as well. So yeah, it's about being perhaps more selective around the areas that India can thrive in, rather than hoping for a whole scale move into manufacturing across the board.
Shilan, that was a really comprehensive response. I'm glad you went roundabout, and yeah, I think what you highlighted is really good in terms of where should India put its weight and focus on, given that there are certain areas where India is clearly making progress and moving forward, and given the scarce policy tools it has in terms of fiscal, at least. So I think what you are saying in terms of aligning priorities becomes very important. But I'm going to move back more to the present, or the near future, not the present, the short term, uh, to leave our listeners with some flavor of your very interesting outlooks that we were talking about before. So let me ask you very clearly, what do you think is the biggest challenge for policy over the next 6 to 9 months? Is it growth? Is it inflation? Is it FI sentiment? What should they be worried about?
Yeah. So for me, the biggest challenge 6 to 9 months, I think, is inflation. That might sound a bit strange because you've got headline inflation coming in at under 4% for the best part of 18 months now, but inflationary pressure is now building. So we've had four separate hikes to fuel prices at the pump over the past sort of month or so, because the government's trying to sort of alleviate some of the fiscal pressure from higher oil prices. Of course, the peace deal and the subsequent fallback in oil prices probably means, at least for now, that there's no further need for hikes to prices at the pump. But the earlier hikes that we've already seen are still going to add about half a percentage point to inflation over the next year or so. So that's one factor. And then another factor is food price inflation as well. Now, this has been rising from around 2% at the beginning of this year to something like 4.5% in May. And we've got the pass through from the elevated fertilizer prices during the Middle East conflict, potential crop damage because of this heat wave that India has been experiencing over the past couple of months. When we start to factor those in, then I think the signs do point to further rises in food inflation. And of course, we haven't mentioned the biggest risk to food inflation, which is a weak or deficient monsoon rainfall on account of the El Nino weather conditions. This has been the prediction of the experts for this year. I believe that the early signs are that monsoon rains have been pretty weak in the first sort of month or so, or the first 3 weeks or so. So yeah, I think that there's a very sort of real possibility of inflation picking up from here, or continuing to pick up from here, and rising to the upper bound of the 2 to 6% target range over the coming months. And the challenge for the RBI in that regard is going to be to ensure that this pickup in inflation because of fuel prices, because of food prices, doesn't then feed through into a broader sort of lifting of inflation expectations. So yeah, I think that that's going to be the key challenge, and one that perhaps is being slightly underappreciated at the moment.
And so, that sets up nicely for conclusion. Let me ask you in two parts what the RBI will likely do if inflation rises to 6%, and then what it should do, in your view.
So I think that as much as possible, it's going to try to refrain from tightening monetary policy and refrain from hiking interest rates. But I also think that it's going to come to the conclusion that over the next few months, with these inflation pressures building, that really that's the most sensible policy path. I mean, the real policy rate in India is still pretty low. So, you could argue that the monetary stance at the moment is actually pretty loose. Certainly, when we compare it to some other emerging market peers. We've had Indonesia, the Philippines hiking interest rates. In Brazil, for example, the real policy rate is already very in quite restrictive territory. It's the opposite for India. So I think that there is scope there to start lifting interest rates without doing sort of major damage to the economy. And that should also help to sort of rein in inflation expectations as well. And then the other point around lifting interest rates is that some of the measures that we've seen around the rupee, and in terms of trying to stabilize the rupee, really they only become effective in an environment of higher rates within India itself in order to encourage those inflows. So that, I think, also argues for slightly higher domestic interest rates as well. So, yeah, for what it's worth, we're forecasting 75 basis points of hikes to the repo rate by early next year. So that would take the repo rate to 6%. That's still below its peak in the past two tightening cycles, where it reached 6.5% in 2018 and in 2022, 2023. So, there is scope for it to go even higher than 6%. But I think that as a starting point, that's what we think the RBI will end up doing, both because of the FX pressure, but because of inflation as well over the next few months.
And what does that mean for the rupee in your forecast?
So that should help to stabilize the rupee. I mean, one could argue that that's already happened, but by encouraging those inflows, by lifting domestic rates, then some of the policies that were announced around the non-resident foreign currency deposits start to look more attractive. I think removing long-term capital gains tax on local bonds again starts to look more attractive when yields are higher. So when we put all of those things together, then yeah, we are expecting a bit of stabilization in the rupee, provided that oil prices remain where they are now, so around sort of $80 per barrel. Then things should start to stabilize for the rupee. So something like 93 to the dollar over the next few months looks reasonable. I one, I wouldn't say it's especially high conviction because, of course, the peace deal is still very fragile. If we did get another spike in oil prices, then that could reverse very quickly. And the other factor to consider within all of this is that it looks likely, at least to us, that we're in for a period of higher interest rates in the US as well. So that sort of suggests, or that points to a stronger dollar. So you've got those kind of conflicting forces. So overall, what it means for the rupee is that it probably stabilizes, maybe appreciates slightly, but not expecting a sort of major rally.
Okay, that puts the risk nicely into perspective. Thanks a lot, Shilan, for joining me and Asia Decoded's listeners. Those were really comprehensive and as well as nuanced responses that you gave to my long list of questions. I appreciate your taking the time.
Thank you. Very welcome.